Okay, well, I make it just gone 11 o'clock, so let's get started. Welcome to our webinar this morning, which is all around EMI schemes or enterprise management incentives. And I'm delighted this morning to be joined by Nimesh Patel, partner here at Grunberg & Co, and also by Anelia Tabakova, who's our assistant manager. So welcome to you. I'm going to hand over to them now to start the presentation off, and I will see you at the end for our Q&A. So over to you, Nimesh.
Thank you very much, Jo. Thank you everyone for joining us this morning. It's great to see many attendees coming to this webinar. I'm sure some of you may have actually watched this webinar when we previously did it last year. So the reason we're doing this webinar is to make people more aware of EMI share schemes because they're becoming more popular, especially since the pandemic. And the reason being is employers are looking for alternative ways to incentivize staff, try to retain their key employees, and to make their remuneration packages more attractive as well. So we'll start off with explaining what an EMI scheme is. So if you go to the next slide, please. So an EMI share scheme is a HMRC approved share scheme. So it's fully recognised by HMRC. So there's legislation which details how the scheme rules work. So it's very much a form of tax planning which is going to be favoured by HMRC because they've already laid out the rules in respect of that scheme. It's available to trading companies. So we're looking at businesses that are not investment companies, but actually carry on an active trade. As I mentioned earlier, the purpose of the share scheme is to reward key employees by offering them share options. And I'll come on to what share options are shortly. And the idea is to try to incentivize employees to grow the value of the business. So for example, the owners may have plans to eventually sell the business and they may want to grow the business so they could actually get a decent price on a future sale. So the idea is to incentivize employees to grow the business by giving them a stake in the business when it eventually is sold. And the idea is to also bring on board key employees, highly skilled workers, without having to pay the top-notch salaries. And also, you know, we're finding a lot of businesses can't be in a position to pay large bonuses at the moment. So an EMI share scheme is an alternative to paying a cash bonus, where you're not having to pay money out to the employee at this stage, but you're encouraging them, giving them something to motivate them to stay at the company. So next slide, please. So we'll look at how share options work, because I'm sure some of you may not be overly familiar. So what happens in the first instance is the company will grant options to the employees they want to give options to. And what is happening at this stage, there's no shares being given to the employees. We're simply giving the employee the right to buy shares in the future at a fixed price agreed between the employer and the employee. So at this stage, it's just an agreement between the company and the employee to say you can buy X number of shares at this price in the future. And usually in the share option agreement, there'll be certain conditions that need to be met. And for example, it could be they want the employee to stay with the company for a certain amount of time before they give them this right to buy shares. It may be the company wants to achieve a certain profit level or certain level of turnover before the employee can basically buy the shares. So the idea is to put all these conditions in the share option agreement so the employee knows exactly when can they buy the shares and what conditions need to be met and how does the company need to perform before they can do that. So once the share option agreement has been prepared, it's signed by the employee and the employer, And then once the employee has met the conditions, they will exercise their options. And what that means is they will exercise their right to buy shares, which means they will acquire the shares and then they will own the shares until they're sold. It might be that the employee cannot buy the shares until the company has plans to be sold. And that's quite a common thing to do because they may not want to, the owners may not want to dilute their shareholdings whilst they own the shares. So you may have a share option agreement where the options can't be exercised until the company is sold. And in those instances, the employee won't actually hold the shares for any meaningful amount of time. So they'll put it, in many cases, they will acquire the shares and sell them on the same day. So there is that option. And alternatively, some employers may want their employees to have shares straight away, or it may be that the employees won't sign the share option agreement unless they can acquire the shares straight away. So we often see clients where they've got an EMI share scheme where the employees can acquire the shares pretty much as soon as they've signed the share option agreement. The advantage for the employee in that respect is they could get dividends from their shares, which makes it more attractive for them. But on the flip side, we see clients where they don't want to give the employees an immediate stake in the company. So they will structure it so they can only buy the shares when the company is going to be sold to a third party. So next slide, please. So this is a HMRC approved share scheme, which means there'll be various conditions that need to be met. So the first set of conditions relates to the company that's going to be granting the options. So as I mentioned earlier, the company has to be a trading company, and the rules are a bit more detailed than that. So they have to carry on a qualifying trade, which means it cannot be what we call an excluded trade. So any clients that are in the financial service, providing financial services, legal services, property development activities, those companies do not qualify for EMI. And if that's the case, then they would need to basically get advice on an alternative share scheme, which is not within the scope of this webinar, but it's useful to know which trades don't qualify. And in terms of the size of the company or the group, so it might be the case that the share options are in a company that's part of a group. So the assets can't be more than 30 million, they need to be less than 30 million. And the number of employees they have, it can't be more than the equivalent of having 250 full-time employees. So when we look at whether the company's got more than the equivalent of 250 full-time employees, we have to take into account all the part-time employees as well to see whether in total it's the equivalent of having more than 250 full-time employees. In terms of how many share options can be granted, the company can grant options on up to £3 million worth of shares. And the other main criteria is that the company that's granting the options can't be controlled by another. So I mentioned earlier, you could have a situation where the company is part of a group. And if the company is a subsidiary of another company, that subsidiary cannot grant the EMI options. They have to be granted by the holding company. So there's that to watch out for. If there's a group, then if you want to do an EMI scheme, you have to grant options in the holding company. So you'd have to take into account what you're giving away there is shares in a holding company, which may give them a stake in other subsidiaries, which you may not intend to do so. So next slide, please. So as well as the company, the employees have various conditions they need to meet themselves. So the director or the employee cannot have a material interest in the company. And what this means is they can't have more than a 30% shareholding in the company. There may be situations where you've got close relatives, such as parents, that also have a shareholding. And if that's the case, you have to take into account their shareholdings as well when you're seeing whether the employee or director has more than 30% of a shareholding. The maximum value over which the employee can be given share options is £250,000. So when you're granting the options, the value of those options can't be more than £250,000. And the employee needs to work for the company for at least 25 hours a week, or at least 75% of their working time. This criteria has been in place pretty much since EMI legislation has come in, but as my colleague Amelia will explain, that particular condition has been relaxed slightly due to the COVID pandemic and the impact it's had on employees' working hours. So next slide, please. So the EMI scheme, why would you want to set up an EMI scheme? The main purposes, as I mentioned earlier, are to incentivize and motivate staff. But in addition, there are various tax advantages as well. So if you were to pay a bonus to an employee, the company would have to account for pay-as-you-earn income tax. It would also need to account for national insurance, and the employer would also need to pay national insurance as well. So it's not very tax efficient to pay bonuses to employees, but EMI share schemes can be much more tax efficient if they're done in the right way. So first of all, when the options are granted, there's no tax at that stage. If the share options are granted and the exercise price, so the price the employee must pay to acquire the shares, is at least equal to the market value per share at the time of granting the options, there'll be no income tax when the options are exercised. So in that situation, there's no tax when you grant the options, and there's no tax when you exercise the options as well. However, if the options are granted with an exercise price that's below the market value at the time of granting the options, then there is an income tax charge when the employee or director exercises the options. But the amount that's taxed is the difference between the market value per share when the options are granted and the actual exercise price paid by the employee. And also, if the shares are readily convertible assets, there'll be national insurance. And what we mean by readily convertible assets is that these shares can be converted into cash. And in one scenario that could happen is if the employee is exercising their options and there's already arrangements for the company to be sold, then those shares will be considered to be readily convertible assets because there's a market created for those shares. Now, although there'll be tax when the exercise price is below the market value per share at the time of granting the options, what we're doing here is actually capping the amount of taxable income. Because, for example, if the value per share is £10 and the exercise price is £5, then the amount that's taxable on exercise is capped at £5 a share. So what the benefit of the EMI scheme in this situation is that if the value of the shares dramatically increases between the time of granting the options and exercising the options, so let's just say the shares are worth £100 a share when you exercise them, you haven't got to pay tax on £100 between £100 and £5. It's only going to be taxed on the difference between £10 and £5 a share. So what you're doing is incentivizing employees to grow the company, but you're doing it in a much more tax efficient way by capping the amount of taxable income in that scenario. So once the employees have got the shares, they'll hold on to them until they're sold, and they'll be subject to capital gains tax when they sell the shares. There'll only be a gain on the shares if they've actually held the shares for any meaningful amount of time. because if they've held the shares for one day because they couldn't exercise their options until the company's been sold, then there won't be any gain made whilst they've owned the shares. But if the options are exercised, for example, this year, and the company is sold in 3 or 4 years' time, then there may be quite a large gain realized between now and then a few years' time. And one of the benefits of the EMI scheme is that you've got more, the employees have got more chance of qualifying for business asset disposal relief. And that is actually the same relief as what was known as entrepreneurs relief. And what that means is that their capital gains are taxed at 10% rather than 20%. So, next slide, please. So we've looked at how the income tax provision is applied under an EMI scheme. So what we'll do now is look at how capital gains applies on shares that have been acquired under an EMI scheme. So when the shares are sold, the employee is liable for capital gains tax. And I mentioned earlier that where you've acquired shares under an EMI scheme, it's easier to qualify for business asset disposal relief. And the conditions below are that there needs to be at least 2 years between the date the options are granted and the date the shares are eventually sold. So there needs to be a reasonable amount of time between those two events. And what it means is that you can't be granting EMI options so close to the sale of a company. It needs to be done well ahead of time. So the longer you delay on an EMI scheme, it could actually impact on this 2-year requirement. For example, if the company's thought about doing an EMI scheme and held off until next year, and there's a sale of the company in the following year, then the employees will be massively disadvantaged by that, because if had they got the share options a year earlier, they would have actually paid 10% capital gains tax rather than 20%. The company needs to be a trading company or a holding company of a trading group, and this would normally be met. As I mentioned earlier, a company doing an EMI scheme needs to be a trading company or a holding company of a trading group. So this condition is pretty much automatically met when you've got an EMI scheme. But it needs to be, this condition needs to be met for a 2-year period immediately before the disposal. So it can't be a case of starting a business and then in 1 year's time it's sold. That's not going to allow the employees to get the 10% rate of capital gains tax. This company needs to actually be trading for at least 2 years to meet condition number 2. And the third condition is that the employee needs to be still working for the company when the shares are sold. So you can't have a situation where the employees are acquiring the shares and then they decide to leave the company. If they do that, they won't get the 10% tax rate. So next slide, please. So the rules I've just explained are quite wordy. I appreciate that. So what we're going to do is go through a couple of examples as to how that looks like in numbers. So the first example here, we've got Newco Limited. They've granted options to Mr. Smith on the 18th of August 2021. The options give Mr. Smith the right to buy 12,000 shares in Newco. And the exercise price, the price at which Mr. Smith must pay for the shares, is £10 per share. And he can exercise the options at any time in the next 10 years. And the other background fact in this example is the market value per share at the time of grant is also £10 a share. So the value per share at the present time is £10 a share, and the exercise price is also £10 a share. And what Mr. Smith will do in this example is to exercise his options in 3 years' time. And at that time, the market value of the shares is £13 a share. So if you move on to the next slide. So what are the tax implications of this scenario? So under an EMI scheme, there's no tax when you grant options. When the options are exercised, I mentioned earlier on, there's no income tax if the exercise price is at least equal to the market value of the shares when the options are granted. In this example, the exercise price was £10 a share, and the market value of the shares at the time of grant was also £10 a share. So what that means is there's no income tax charge when the options are exercised. When Mr. Smith sells the shares, he'll be liable to capital gains tax when he sells the shares. And the deductible cost when working out the capital gain will be £10 a share, because that's what he paid for the shares when he acquired them. And his proceeds are £13 a share. So what you'll have is a capital gain on £3 a share. And if he's met the conditions for business asset disposal relief, then he'll get a 10% tax rate on that capital gain. So if you move on to example 2, sorry, if you go back a slide, please. Yeah, so example 2 is a slightly varied scenario. So we got Mrs. Smith. She's also an employee of Newco Limited. And what Newco Limited have done is to grant options to Mrs. Smith on the 25th of August 2021. And with those share options, she has the right to purchase 5,000 shares. And the price per share that she has to pay to acquire the shares is £10 a share. However, in this scenario, the market value per share at the time of granting the options is £12 a share. So in this scenario, the exercise price is actually lower than the market value per share at the time of granting the options. And what Mrs. Smith will do in the future is to exercise her options, and the market value per share at the time of exercising her options in August 24 is £15 a share. So the next slide will illustrate the tax implications here. So once again, there's no tax when you grant the options. However, there will be income tax when the exercise of options takes place. The reason for that is the exercise price was £10 a share, and the value per share at the time of granting the options was £12 a share. So what we have here is options are granted at a discount, and the discount is £2 a share, so £12 minus £2 a share. If the shares are readily convertible assets, so for example, if they're listed or there are arrangements to sell the shares, then Mrs. Smith will pay national insurance. We would normally see readily convertible assets if they are shares that are going to be sold. It's very unusual to find EMI shares that are listed. So Mrs. Smith would have to pay not only income tax on that £2 a share, but also national insurance as well. And when the shares are sold, there's also capital gains tax, and that'll be based on the rules I mentioned earlier. So there's that 10% tax rate you can get, because there would have been at least more than 2 years between the date of grant and the date that shares are sold. And also in terms of national insurance, if the employee has to pay, then the employer also has to pay national insurance as well. So next slide, please. So just to show you how example 2 works in numbers. So here we've got options that are granted at a discount. So the market value is £12 a share when the options are granted. So to work out the taxable income when the options are exercised, we look at the market value of the shares at the time of grant. So that would have been £12 a share multiplied by 5,000 shares, which gives you £60,000. The exercise price has to be deducted. So this employee paid £10 a share for their 5,000 shares. So they paid 50,000 in total. And the difference, the discount, is £10,000. And that's the amount, that's taxable income at the time of exercising the options. So next slide, please. So when the shares are sold, there'll be capital gains tax. So let's just say that Mrs. Smith sold the shares on 18th of August 2026, and they were worth £17 a share. As there's been more than 2 years between the date of grant of options and the date of sale of the shares, then business asset disposal relief should apply. One caveat on that is business asset disposal relief can only be claimed on up to £1 million of capital gains during the individual's lifetime. So the first thing to do is to check whether the individual has actually claimed this relief previously. If they have, then there may be a restriction on how much of the gain qualifies for the 10% rate. And also you might have a scenario where the company does extremely well and the employees actually made a gain of more than £1 million. And if that's the case, then the first million is taxed at 10% and the remainder at 20%. So next slide, please. So just to work out the capital gains tax for this employee. So they've sold the shares at £17 a share. So that's 5,000 shares at £17. So that's £85,000 proceeds. They have exercised the options at £10 a share. So they paid 50,000. So that should be deducted when calculating the capital gain. And also we deduct the amount that's already been taxed. So that £10,000 that was taxed earlier, that's also deductible as well. So the reason for that is that the employee should not be paying income tax and capital gains tax on the same amount there. So that's why £10,000 is also deducted. And what we've got here is a £25,000 gain. If we assume the individual hasn't made any other sales in the same tax year, and the annual exemption remains at the same amount as it currently is, then they can deduct 12,300, which means the taxable gain is 12,700. And assuming the 10% rate applies, their capital gains tax is 1,270. So that's how the share options work mechanically, and also gone through the benefits of the scheme. Once the options have been granted, there's quite a bit of administration and quite a large process to follow as well. So my colleague Anelia will guide you through how that works.
Thank you, Nimesh. So we're moving on to overview of the process. A typical timescale of setting up an EMI scheme, preparing a valuation report and applying for HM revenue and customs clearance might be 2 to 3 months. The process begins with identifying the key employees that the company would like to give shares to. The board decides to set aside what we call an option pool of a certain size. And the option pool is typically between 10 and 20% of the company share capital. There are no set rules, and this is best decided, the size of the pool is best decided or agreed among the existing shareholders. You don't have to grant all the shares in the option pool immediately. Some can be reserved, or a balance can be reserved for future employees, or simply leave some of the balance unallocated in the pool. The option pool is an arrangement on paper, and the share options remain in the pool until the company grants the share options. The shares themselves do not exist until the option is exercised and the new shares are actually issued. The next step would be for the board to create a cap table, and a cap table is an Excel spreadsheet. The cap table will show the name of the existing shareholders and the number of the shares they hold, the names and the number of shares of share options to be granted to the option holders, if there's any unallocated balance of the option pool, and the nominal value of the shares. The next step for the company will be to prepare a company valuation report, which is submitted to HM Revenue and Customs for approval. And the valuation report is valid for 90 days, but temporarily extended to 120 days due to COVID-19. The next step will be to prepare a share option agreement and a working time declaration for each option holder. And the share option agreements are the mechanism of granting the options to the employees. And the working time declarations are to demonstrate that these employees are eligible employees. And they're working for the company for at least 25 hours a week, or if less than that, at least 75% of their working time. The documents are signed both by the company and by the employees. And the date of grant is the date specified on the share option agreement. The next step for the company would be to register the EMI scheme with HM Revenue and Customs through their own government gateway account. If the company does not have a government gateway account, they can create one using HM Revenue and Customs website. So once the EMI scheme is registered, HM Revenue and Customs will issue an EMI reference. The EMI reference is then used for the next step to notify HM Revenue and Customs about the granting of the shares. And the notification must be submitted within 92 days of grant of the options. The next and final step in the process is for the company to submit an EMI and a FIA return by 6th of July. And if a company registers an EMI scheme, then every year they'll have to submit an online return, even if there hasn't been any activity during the year. If the company has activity during the year, then the activity must also be reported on the annual return. And there are 4 kinds of activity: exercise of the options, lapse of the options, or replacement of options and adjustments of options. Lapses occur normally when someone leaves the company, and if the employee, even if the employee is allowed to keep their options after they've left the company, unless they exercise their option within 19 days, these options are not an EMI qualifying options anymore. Now moving to the next slide. Is COVID-19 impact on EMI share options? As we already explained, an eligible employee is an employee that works for the company for at least 25 hours, or if less than that, 75% of their working time. Otherwise, a disqualifying event will occur, and the option could either be exercised within 90 days of the lapse, or be disqualifying event, or it's not an EMI option any longer. So now HM Revenue and Customs rules have confirmed that the rules will be relaxed, and the relaxation will continue until 5th of April 2022. And if an employee is on furlough, on sick leave, or works on reduced hours, disqualifying event will not occur, and the employee will not be forced to exercise their options. And this is the end of our webinar, and it's now time for questions and answers. Thank you.
Great, thanks very much, Nimesh. Thanks very much, Anelia. I've got a couple of questions that have come in. First one is asking about EMI schemes in a company that's loss-making. Can they still operate an EMI scheme if they're not profitable?
Yes, they can. So there's no requirement for the company to be profit-making. There's no conditions that relate to the financial performance. The main company criteria are around the size of the company. So I mentioned they can't have more than 250 full-time employees. Their assets can't be worth more than 30 million. So if any companies are loss-making, then actually an EMI scheme is actually quite common in that scenario, because it could be used to try to incentivize employees to turn around the performance of the company. And also, it might be the company's in its early stages where they've got a lot of expenditure. And EMI schemes are actually quite popular in startup companies as well. So it's very much a common scenario.
Mm. Okay, and a question here about a company that's looking to issue growth shares. Can they be included in an EMI scheme, or do they have to be? Does that have to be run separately?
So with growth shares, we've seen it done two ways. So they can be encompassed into an EMI share scheme. The growth shares are different to normal shares because growth shares entitle the shareholder to value when the company's actually grown, as opposed to giving any immediate value. But that can still work under an EMI scheme. However, we normally see growth shares as an alternative to EMI. So if for some reason the company doesn't qualify for EMI, then growth shares can often be an alternative solution, because the growth shares have limited value at the beginning, which means it's another tax efficient way to give shares to an employee. But the EMI scheme is still the better scheme if the company qualifies, because I mentioned the 10% tax rate can be very attractive to the employee.
Okay. A couple of questions here from Ian. Thank you, Ian. First one, who does the valuation? How's that done, and what's the likely cost implications of that?
So the valuation, we would usually do the valuation and submit it to HMRC for approval. The reason we would do the valuation is the valuation report, the calculations are primarily based on the accounts of the company. So we're in a good position to do that work if we also do the accounts. In terms of our costs, it's not a one size fits all. It just depends on the complexity in terms of whether do we have a startup company, do we have an established company. If you're trying to value a group of companies, then the task is obviously a lot larger. So in terms of cost, it would depend on the type of company we're looking at. But obviously we would review that first and give a quote beforehand.
And I presume, just following on from another question from me, that in terms of the whole process, that again depends on the business and the requirements of the business. It's not a one size fits all.
Yeah, I mean, in the beginning, we have to actually evaluate and make sure the company is qualifying before we actually proceed with an EMI scheme. So I mentioned there are certain trades, for example, those that providing financial services don't qualify, for example. So we just want to tick all the boxes first, and then we can work out with the company as to what the plan is, work out these are the steps and the timescale that goes with it. Okay.
All right, well, I think that covers everything that we've got through. Again, thank you very much, Nimesh. Thank you, Anelia, for a great presentation. We have been recording this, so we will make a copy of this available on the website later on today, and a copy will be sent to everybody that's registered and attended. So thank you for attending, and I hope you have a good rest of the day.